Welcome back. You're with us on Closing Bell, and we have Vikas Khemani, founder at Carnelian Asset Management, now joining in to get some perspective on what's turning out to be the first real fall this market has seen in many, many months, dare I say years, ever since we came out of COVID. Vikas, thanks very much for joining in. So, some perspective and big picture sort of thought is much needed at this point in time, because the fall from the peak is about 8% now. And we were just speaking to some chartists before, you joined in. And they are saying this could go on, maybe another, 5% on the downside. Your thoughts on where we are, how we are poised, and what the best approach would be right now? First of all, do you think that we are close to the bottom, or would you not be surprised if it continues for a bit?
So we've been in a one-way kind of a bull market for last 3-4 years. We made significant returns this year, across the board. So whenever this kind of rise happens, bit of a correction, consolidation, is always good. And it's not 8% from the top is not like a lot of correction. If you see last 10, 15 years or any period of history, there are times in otherwise bull market, you see 20-25% correction as well. So it really depends on the nature and the type of the market. Last 2 years, the most of the corrections were short-lived and very shallow. I think this is the first time probably you are seeing slightly wider correction or deeper correction, especially in mid and small cap space. And that is, I think, probably creating a little bit of earn situation in the market. Also, it has got coincided with bit of a redirection of the flow towards China, and also a little bit of sort of softening in the earnings season. So I think it's good that this kind of correction sort of is taking place. It is always healthy, in my opinion, from a medium term to long term perspective. I have no doubt that the long term fundamental structures of India is in place, intact. We are in the middle of a structural bull market, but intermittent corrections are necessary, and this is one of them. Many more will come in the future. Regarding your question, whether are we close to the bottom, I'm not sure that, depends on really how far, market settles down. But I don't see a situation where markets can correct, let's say, from the top 20% kind of number, but probably 3, 4, 5% from here more could get market stabilized. And I would always say that any panic kind of markets are the best markets to kind of deploy capital to sort of make fresh exposures, and especially in the mid and small cap space, a lot of deeper corrections have happened. 30, 40, 50% corrections in many stocks have happened. So look for your own picks, look for ideas, and no need to be rushed. I don't think markets are running away up in a hurry. So we will see a good consolidation phase of the market. I would call a 22,000 to 25,000 kind of nifty broader range market should remain between for next 3 to 6 months.
22,000 to 25,000 is the range for the next 3 to 6 months on the Nifty. So where are you deploying the money right now, Vikas?
So right now, I think, fortunately we've not created a lot of cash, but for last 1 month, whatever money we received, we didn't deploy. We are kind of sitting pretty much on cash, on whatever the fresh inflows came, because we were kind of a little bit concerned about the direction of the market. But having said that, we are looking for an opportunity, stock specific. We are eyeing on ideas, and we will buy as and when we think it's right time to deploy capital, right time to kind of bite into the. And at the end, we don't deploy at the market level. We deploy in the companies, and so for us, the company and the target price of those companies is far more relevant than really the market levels.
No, absolutely. I think one of your ideas is doing well today. Loris was up 6-7%. Vikas, hi afternoon. You said 22 to 25. Will the lower end come into play at some point? I think
nobody can call that out, to be honest. They really depends. Many things could be flows, could be market sentiment. So 3, 4, 5% correction can, so whether we will go to 22 or not, I don't know, honestly. But broadly, right now, the mood has shifted on kind of sell on rallies to buy on dips kind of market. So I think it kind of consolidate the easy money, which everybody got used to. I think is being questioned, and that's a good situation to be in my opinion, because markets are not, the way people have made money last 1.5 years, 2 years. It became very easy, and I think good that reality check happens, the expectation gets toned down, and that's always healthy for
Yeah.
a long-term structure of the market.
Yeah, a lot of FII selling has happened because in your earlier life, you've also been on the institutional side, the sell side, etc. as well, right? You've interacted with all the big foreign investors here in India. I'm sure you speak with those people as well. So give us a sense of what is happening. I mean, the selling that we've seen, what's driving it, and what's the mood like there in that constituency?
I think, Prashant, I don't think mid and small cap selling is driven by the FIs because there's not a lot of expectation or exposure out there. But I would like to give you a little bit of picture that I think if you last 3-4 years, we saw a lot of money going away. So whenever Fed raises interest rates, FI pull money out of the country, right? Out of the emerging markets. And that's what happened. India lost money when Fed was raising interest rates. And I think in my previous interactions, I had said once it starts coming down, the Fed rates peaks out and starts coming down, you will see FIs flow coming in. So which began when the Fed cut rate, we saw FI flows coming back into Indian markets, in emerging markets, including India. But recently, because of FIs were significantly underweight in China, because of recent change in policy in China, a short-term and the market setup change in China, short-term reallocation has gone back to China. In my opinion, broadly, more or less, that has settled down. Now, any incremental money flow which is coming towards emerging market, will only kind of be positive from India. So it could remain 1-2 months here and there, cannot be rolled out. But I do believe that India will continue to receive large part of the flow, large part of emerging market flows, and emerging market in general will receive more flows because Fed rate is expected to come down further, and the trajectory is looking only downwards. So as that plays out over next 6 months, 12 months, 18 months, you will see more and more flow coming from FI. So no FI is leaving India. It is actually reallocation of the flows first, between China and India. And as the overall basket goes up towards emerging market, you will see more flow coming towards India. So I don't think there's any reason to panic or worry. No FI, according to me, is taking any negative view on India. So that narrative sort of probably may not be correct. And that is how I will see. And as India delivers and remains over next 3, 4, 5 years, I see a situation where FIs will continue. I mean, today, most FIs are underweight India. In general, I'm talking overall FI flows. If FIs will to become, all global assets were to become Indian, equal weight in Indian markets, India can get anywhere with $1 trillion kind of flows over next 8 to 10 years. So we should keep that broader picture in mind rather than getting worried with the short-term monthly outflows.
Okay, absolutely. So don't keep the short-term myopic view. Don't let that cloud your long-term and medium-term judgment. Take that point completely, Vikas. Tell us a little bit about yourself and how you've been looking at the market. And I mean, you have been doing exceedingly well, right, with the whole theme around capex, the PLI segments, the key beneficiaries, manufacturing. But as the market has been now cooling off, have you been taking some profits as well? Are you redeploying? I mean, what's the change in the portfolio? Any broad, big change, if any?
I said that we've not deployed capital in the last 1.5 months because we were kind of expecting some corrections. But within that, we have taken some money off table in some of the overvalued names where we thought things have played out. So, but it's not that we're sitting on a lot of cash. I think we are about 5-6% odd cash we're sitting on system, and which I think we will not be in a hurry to deploy. Otherwise, I don't think, in my opinion, any broad changes in the India story happens. We will see financials doing very well. We'll see manufacturing doing very well over next 12 months or even longer. We continue to believe that, entire IT pack, within IT, there's interesting place where one can continue to do well. So broadly, our thesis has not changed on India story. A little bit of here and there can happen. We have not made, I can tell you, a lot of changes in our portfolio. We are quite comfortable with what we have in our portfolio right now.
What about banks and the earnings that we've seen? You are bullish on banks over the longer term, but just purely talking about what we've seen in Q2 and the broad-based nature of the rise in stress, particularly in unsecured lending. Do you think it's going to last for, 1 or 2 quarters? Or typically when such cycles take place, they tend to last a little longer, maybe for a year, maybe even longer. Are we at the beginning of such a longer-term cycle? assess the
I think
tenor of this stress?
I would not believe a very long, but I would say 1 or 2 quarter of, see, typically a lot of unsecured loan growth happened, in last 1 to 2 years, and that is where RBI has also raised a bit of alarm. And I must give credit to RBI for being such a counter-cyclical measure and kind of raising that alarm before it becomes too big. So I think that was a great job, and that has, I think, alerted the system. So the growth has started slowing down, and a little bit of pressure. A good part is that the unsecured note loans is not a very large part of the overall portfolio of many banks, especially the ones where we have invested. I mean, ICICI Bank is reasonably well placed. So most of the companies that least we have exposure to, they are very well placed. They don't have very large exposure. Of course, some of the microfinance piece is kind of under stress, which is where we saw yesterday IndusInd Bank's number coming through. We don't own it, but the fortunate part is that so you need to be worried about, I think, microfinance as well as the unsecured loan. Maybe a quarter or two, most of the pain should be behind, partly through provisioning, partly through slowdown in the growth. And most banks, once they are agile and alerted, they will take corrective actions. So I guess probably a quarter or two should be the pain in the system.
All right, Vikas, we'll leave it there. Good conversation and a good perspective, and we'll continue to get you on the program as we assess this sell-off. On the nifty, mid-cap and small-cap spaces, we are now approaching, we're almost there, the 10% correction levels from their respective highs, 9.8 for the mid-cap and about 9.7 for the small-cap in indices. The Nifty has lost about 8.3, Bank Nifty has lost about 7.5%. So that's the state of affairs from the respective all-time highs.